October 24th, 1929. The New York Stock Exchange, Lower Manhattan. Traders watch sell orders flood the floor as prices begin to break. By noon, some of the most celebrated stocks in America are falling faster than buyers can absorb them. The panic did not begin that morning. For most of the 1920s, the United States had been living through an extraordinary expansion. Factories produced more cars, radios, appliances, and consumer goods than ever before. Corporate profits rose, newspapers celebrated new fortunes, and millions of Americans came to believe that stocks could keep climbing. Then speculation accelerated. Investors increasingly bought shares on margin, paying only part of the price and borrowing the rest. Rising prices made the system look safe because gains covered the debt. Falling prices would do the opposite. By 1928 and 1929, money was pouring into the market from people who had little experience with stocks. Brokers promoted easy credit. Investment trusts multiplied. Banks and other lenders helped feed a vast market for brokers' loans. Famous companies traded at valuations built on expectations that growth would continue. The market reached a peak in early September 1929. Then confidence began to weaken. Prices slipped, recovered, and slipped again. On October 24th, later remembered as Black Thursday, selling turned chaotic. A group of leading bankers stepped in and bought major stocks in an attempt to restore confidence. For a moment, it seemed to work. The market stabilized, and newspapers suggested the worst might be over. It was not. On Monday, October 28th, prices collapsed again. The Dow Jones Industrial Average fell sharply as investors rushed to sell before their losses grew. Margin calls forced borrowers to produce more cash or surrender their shares. That meant falling prices created more selling, which created still lower prices. Then came October 29th, 1929, Black Tuesday. More than 16 million shares changed hands, an extraordinary volume for the time. Telephone lines and ticker machines struggled to keep pace. Prices printed on the ticker could already be obsolete by the time investors saw them. Some fortunes disappeared on paper in hours. The crash did not destroy every bank overnight, and it did not single-handedly create the Great Depression. But it shattered confidence at exactly the moment the economy was becoming vulnerable. Consumers cut spending. Businesses delayed investment. Production slowed. Unemployment began to rise. Then banking crises made the contraction far worse. Thousands of banks failed during the early 1930s, wiping out deposits in an era before federal deposit insurance. Credit became harder to obtain, which pushed more businesses and households into distress. The downturn spread beyond the United States through trade, debt, and the international financial system. By 1933, the American economy had contracted dramatically. Unemployment had reached catastrophic levels, and the optimism of the previous decade had been replaced by fear. Washington responded with a wave of reforms. The Securities Act of 1933 and the Securities Exchange Act of 1934 imposed new disclosure rules and created federal oversight of securities markets. The Glass-Steagall provisions of the Banking Act of 1933 separated important commercial and investment banking activities, while the same law created federal deposit insurance. The crash became a symbol of what happens when leverage, speculation, weak safeguards, and collective confidence reinforce one another. It also changed how Americans thought about markets, banks, and the government's role in financial stability. In the 1920s, rising prices made risk look invisible. In 1929, falling prices made debt impossible to ignore. The market would eventually recover, but the world that believed prosperity was permanent had already ended. October 29th, 1929,